Here is a number, 37%. That is how much the purchasing power of the US dollar has declined in just the last 10 years. Not since the Great Depression, not since World War II, in the last decade. Meaning, the $20 sitting in your wallet today buys what $13 bought in 2015. The money didn't disappear. Nobody took it from your account. Your balance looks exactly the same, but roughly a third of its value quietly evaporated while you were living your life. And here is the part that should bother you. That didn't happen by accident. It happened by design. And the people who designed it are the same people who told you inflation was transitory, that it was Putin's fault, that it was supply chain disruptions, that it was anything and everything except the most straightforward explanation available, which is that when you print trillions of dollars and inject them into an economy, the value of every dollar that already exists goes down, every single time, without exception. It is not complicated. It is arithmetic. But inflation is not just an economic phenomenon. It is a wealth transfer mechanism. And today we are going to follow the money. Because once you see exactly who wins and who loses every time inflation runs hot, you will never read a Federal Reserve press release the same way again. Let's go back to the beginning. Because this is not a modern problem, and it is not a uniquely American problem. Governments have been debasing currency since the Roman Empire. And the mechanism has always been the same. You need money you do not have. You create more of it. The new money dilutes the old money. And everyone holding the old money quietly gets poorer, while the entity that created the new money gets to spend it at full value before the rest of the economy figures out what happened. The Romans did it by literally shaving the edges off silver coins and using the shavings to mint new coins. Medieval kings did it by reducing the silver content of their currency while keeping the face value the same. And modern governments do it by instructing their central banks to expand the money supply through bond purchases, interest rate manipulation, and a collection of monetary policy tools that are specifically designed to be complicated enough that most people stop paying attention halfway through the explanation. The tools change. The mechanism does not. Create money. Spend it first. Let everyone else absorb the cost through rising prices. Repeat. And here is where it gets personal, because inflation does not hit everyone equally, not even close. And the gap between who it hurts and who it helps is not random. It is structural. It is baked into the system. And it runs almost perfectly along the line between people who own assets and people who do not. Meet Sandra. Sandra is 43. She works as a hospital administrator in Cincinnati, earns $68,000 a year, has about $12,000 in a savings account, earning 1.2% interest, rents her apartment, and drives a car she is still making payments on. Sandra is solidly middle class by almost any measure. Sandra works hard. Sandra saves responsibly. And inflation is quietly destroying Sandra's financial life in 3 separate ways simultaneously, and she cannot see any of them happening in real time. First, her savings account. Sandra's $12,000 is earning 1.2% annually. Inflation over the last 3 years has averaged roughly 5.8%, meaning in real terms, Sandra's savings are losing 4.6% of their purchasing power every single year. She is not spending the money. She is not making bad decisions. She is doing exactly what she was told to do. Save your money. Put it in the bank. And the bank is paying her 1.2% to hold money that is losing value at nearly 5 times that rate. The savings account is not protecting her wealth. It is just making the loss feel invisible. Second, her wages. Sandra got a 3% raise last year. Her employer called it a strong performance increase. Sandra felt good about it for approximately 2 weeks, until she noticed that her grocery bill was up 18%, her electricity bill was up 11%, her car insurance renewal came in 22% higher, and her rent notice arrived with a 9% increase attached. Sandra's 3% raise did not make her better off. It made her 6% worse off in real purchasing power terms. The raise was not a reward. It was a consolation prize that did not cover the entry fee. Third, and this is the one nobody talks about at Sandra's income level, she does not own assets. She rents. She has no stock portfolio worth mentioning. She has no real estate equity. And asset prices, stocks, housing, commercial real estate tend to rise during inflationary periods because hard assets hold value better than cash. So while Sandra's savings erode and her real wages decline, the value of assets she does not own goes up. The wealth gap between Sandra and the people who own things does not just persist during inflation, it accelerates. Now meet Douglas. Douglas is 57. He owns a 4-bedroom house he bought in 2004, has a stock portfolio worth approximately $900,000 split between index funds and blue-chip equities, owns 2 rental properties, and carries a 30-year fixed-rate mortgage at 3.2% on his primary residence. Inflation is one of the best things that has ever happened to Douglas financially, and Douglas did not do anything particularly brilliant to make that happen. He just owned things before the money supply expanded. Here is why. Douglas's mortgage is fixed at 3.2%. If inflation is running at 5%, Douglas is effectively paying negative 1.8% in real interest. The bank lent him money that is worth less every year, and Douglas gets to pay it back in increasingly cheap dollars. His lender is losing. Douglas is winning, simply by existing as a borrower with a fixed-rate loan in an inflationary environment. His real estate has appreciated dramatically because housing is a hard asset and hard assets absorb inflation. His stock portfolio has largely kept pace with or exceeded inflation because equities represent ownership stakes in companies that can raise prices in response to inflation and pass the cost to their customers, which is to say, to Sandra, and his rental income goes up with inflation. When Sandra's rent increases 9%, that 9% flows directly to someone like Douglas. Sandra's inflation loss is Douglas's inflation gain. This is not a moral judgment about Douglas. Douglas did not design the system, but understanding this dynamic is essential because inflation is not a natural disaster that falls randomly from the sky. It is a predictable wealth transfer from asset poor to asset rich, from saver to borrower, from wage earner to property owner, every single time. And here is the mechanism that makes it worse. The entity responsible for managing inflation in the United States is the Federal Reserve. The Federal Reserve was created in 1913 in a meeting that is somehow less controversial than it should be, and its stated mandate is to maintain price stability and maximum employment. 2 goals, one of which it has been missing spectacularly for the last several years. But here is what the Federal Reserve does not advertise about itself. It is not a government agency. It is a privately owned institution with a government charter. Its board is appointed. Its decisions are made without a public vote. And its primary customers, the entities it is most structurally accountable to, are the commercial banks that own its shares and rely on its policies to function. And commercial banks love moderate inflation because banks borrow money at short-term rates and lend it out at long-term rates. When inflation runs above the rate banks pay depositors, which is most of the time, banks are collecting real positive returns on loans while paying depositors negative real rates. The spread between what the bank pays Sandra for her savings account and what the bank charges someone else to borrow that same money is one of the most durable profit mechanisms in the history of capitalism. And inflation makes that spread wider. This is not a conspiracy theory. It is a balance sheet. The numbers are public, the incentives are obvious, and the outcomes are consistent across decades and across countries. Now let's talk about the government side of this, because sovereign governments have their own very specific relationship with inflation, and it is a relationship built entirely on self-interest. The United States currently carries approximately $36 trillion in national debt. 36 trillion. That number is so large it has essentially lost meaning for most people, so let's put it differently. If you spent $1 million every single day starting from the birth of Jesus Christ, you would still not have spent $1 trillion by today. The US government owes 36 of those, and every year it adds more. Now here is the critical insight. Government debt is denominated in dollars, and the government has influence over how many dollars exist. If inflation runs at 5% annually, the real value of that $36 trillion debt declines by 5% in purchasing power terms every year. The government is paying back its creditors in money that is worth less than the money it borrowed. Inflation is effectively a partial default that is polite enough not to call itself a default. This is why governments throughout history have found inflation convenient, not in an emergency, not as a last resort, consistently, predictably, because it reduces the real burden of debt without requiring the political cost of raising taxes or cutting spending. It is a tax that does not appear in any budget. It does not require a vote. It does not have a line item. It just quietly extracts value from everyone who holds dollars and transfers it to everyone who owes dollars. And the largest dollar debtor on earth is the United States federal government. And here is the most modern layer of this problem. Because what happened between 2020 and 2023 was not a unique historical accident. It was the largest and fastest expansion of the money supply in American peacetime history. The M2 money supply, the broadest measure of money in circulation, grew by approximately 40% in roughly 2 years. 40%. And then inflation arrived and everyone acted surprised. Politicians blamed corporations for price gouging. Economists debated supply chain models. The Federal Reserve called it transitory for 18 months and then raised rates aggressively when it became impossible to call it anything else. But nobody in a position of institutional authority stood up and said the straightforward thing, which is that we created 40% more money, and prices went up roughly 40% over several years, and these two facts are not a coincidence. They are a cause and an effect. And the people who got to spend that new money first, the government, the banks, the large financial institutions, got to spend it before prices adjusted, and everyone else absorbed the adjustment afterward. So what do you actually do with this information? Because understanding the mechanism is useful. But useful only if it changes your behavior. Stop holding large amounts of cash long term. Cash is the asset most directly destroyed by inflation. An emergency fund in cash is essential. A retirement plan built on cash savings is a slow-motion loss. Move savings into assets that have historically held value against inflation. Equities, real estate, treasury inflation-protected securities, and commodities have all outperformed pure cash over inflationary periods historically. Understand that your salary negotiation is actually a purchasing power negotiation. A raise below the inflation rate is a pay cut. Treat it accordingly and negotiate accordingly. If you carry fixed-rate debt at a low interest rate and inflation is running above that rate, understand that in real terms that debt is shrinking. This does not mean take on reckless debt. It means understand the real cost of existing debt in an inflationary environment. Pay attention to real returns, not nominal returns. Your savings account paying 2% when inflation is 4% is not making you 2%. It is losing you 2%. The number going up in your account is not the whole story. And diversify across asset types, not just across stocks. Inflation affects different asset classes very differently. A portfolio built entirely on one type of asset is not diversified against monetary risk, even if it holds 50 different individual positions. Because here is the bottom line. Inflation is not a weather event. It is a policy outcome. It is produced by decisions made by institutions that are accountable to specific constituencies. And those constituencies are not Sandra. They are Douglas. They are the banks. They are the government. And they are every large borrower who benefits from paying back debt in depreciated currency. The 3-digit credit score system was built without your vote. The 401k was an accident that became a mandate. And inflation is a tax that never appeared on a ballot. 3 of the most powerful financial forces shaping your economic life were designed by someone else, for someone else, and then handed to you as the default setting. So here is where I want to hear from you. Do you think inflation is primarily a policy failure, where institutions made genuine mistakes? Or do you think the outcomes are consistent enough and the beneficiaries specific enough that calling it accidental is giving too much credit to coincidence? And where are you personally right now? A. You've already moved meaningful savings into inflation-resistant assets. B. You're still mostly in cash or low-yield accounts, and this video just made you uncomfortable. Or C. You understand the problem but have no idea where to actually start. Drop it in the comments, because the answer most people don't want to say out loud is probably C. And that is exactly the gap between knowing and doing that costs people the most money over a lifetime.